So this was probably back in the 1970s. I was at William Blair and Company, and the guy working, my back office guy, Dave Orbeck, calls me on the trading desk, and he says, "Hey, they made a mistake. They were supposed to send us $30,000, but they accidentally sent us $300 million." Now, back in 1979, $300 million was a lot of money. I said, "What happened?" He said, "Well, the guy at the Fed, they had those old adding machines and calculators where they were manual. When he was typing in the number, he accidentally hit the 000 instead of the 0 or something like that. So he accidentally gave us $300 million instead of $30,000. This is good money. You go out and spend it. So where does the money come from? It comes from the guy's thumb at the Federal Reserve Bank in New York."
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley, and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For a small donation, you can get early access to our episodes, and there will be bonus episodes in future. You just heard my guest this week, father of modern monetary theory, Warren Mosler, talking about where money comes from and clarifying that the best central bank staff are the ones with the biggest fingers. Possibly nobody understands how modern money works better than Warren. As a person who has traded money in one form or another his whole professional life, he is attributed with creating Moslers Law, which states, "There is no financial crisis so deep that a sufficiently large fiscal adjustment cannot deal with it." In the early 90s, prevailing wisdom and academic economists were predicting that the Italian government was about to become insolvent because of their 110% debt to GDP ratio. Warren, then a hedge fund manager, thought differently. He flew to Rome for a conversation with senior Treasury officials about how their monetary operations worked, and to confirm his hypothesis that a government that has debts denominated in its own currency which it issues, can always pay its debts. This is a key MMT insight. A week after this meeting, the Italian Ministry of Finance issued a statement that in regard to all Italian government bonds, quote, "no extraordinary measures will be taken. All payments will be made on time," unquote. The trading position Warren took at the time, based on his original insight, made his clients happy. You can read the actual figure in his book, which is free on his website. Even if understanding how modern money works has rewarded him over the years, Warren became increasingly dismayed to hear politicians and pundits the world over talking as if their governments could run out of money, as they defunded public services and shredded social safety nets in the name of fiscal responsibility. He told an economic conference in Italy in 2014, quote, "It's been so long since we've had a good economy. You've got to be at least as old as I am to remember it. In a good economy, business competes for people. There is a shortage of people to work for business. Everybody wants to hire you. They'll train you, whatever it takes. They hire students before they get out of schools. You can change jobs if you want to because other companies are always trying to hire you. That's the way the economy is supposed to be, but that's all turned around. For one reason, the budget deficit is too small. As soon as they started tightening up on budget deficits many years ago, we transformed from a good economy, where the people were the most important thing, to what I call this crime against humanity that we have today," unquote. I say we can turn our economies back into the one Warren was describing. We can demand the policy options denied to us based on so-called fiscal responsibility. We just need to understand modern money. Hi, Warren. Welcome to the MMT Podcast. How are you?
Good to hear from you, Christian.
I really wanted to kick things off with a story, and I know that you have a great one about being accidentally given, I think, $3 million by the New York Federal Reserve. Could you share that story for our listeners?
Sure. So, the question that I address with this story is, where does the money come from? So this was probably back in the 1970s. I was at William Blair and Company, and the guy working, my back office guy, Dave Orbeck, calls me on the trading desk, and he says, "Hey, they made a mistake. They were supposed to send us $30,000, but they accidentally sent us $300 million. Now, back in 1979, $300 million was a lot of money. So I said, great, let's get out and spend it. He goes, well, the wire's closed now, so we're going to have to wait till tomorrow. I said, okay. I said, well, how much interest are we going to make overnight? And the rates were, I don't know, were 12% or something. So it was like millions of dollars just in interest, which, it's just a lot of money to make a mistake. So anyway, I said, what happened? He said, well, the guy at the Fed, they had those old adding machines and calculators where they were manual. When he was typing in the number, he accidentally hit the 000 instead of the 0 or something like that. So he accidentally gave us $300 million instead of $30,000. Okay, so the question is, this is good money, you go out and spend it. So where does the money come from? It comes from the guy's thumb at the Federal Reserve Bank in New York. So anyway, later on that evening, he called me back and said they found their mistake, and they reversed it. They discovered their mistake and reversed the numbers, and so we didn't have the money anymore.
Otherwise, finish, please.
Otherwise, I wouldn't be here talking to you right now.
So when it was reversed, what happened? Did you have to do something, or did they,
No.
take it out? Did they delete it?
We had to give them instructions to be able to change the number back to 30,000 to remove the extra 3 zeros or whatever it was. The guy 4 zeros. The guy hit with his thumb.
So the story really goes to what is money, and so I think it'd be useful to talk about what makes a currency. And you give a great talk. I haven't heard you do it for a while, but it's about how to turn litter into money. Could you share that with our listeners? Yeah.
So what distinguishes modern monetary theory is how it tells the money story. You'll read in textbooks and other places. You might have two people on a desert island and they decide exchanging things and they use seashells or something, or you have a community doing barter and with each other, then they decide there's some convenience to use something else. Now, that's all fine. I'm not saying that never happened, but for modern monetary theory, we begin the money story with a state that's trying to provision itself. So you have a group of people that want collective action because they want a military, or they want a legal system, or they want public health or public education, or any type of collective action like that. And then you have to provision it. You have to have soldiers, you have to have judges, you have to have food for the cafeteria. And, how do you get these things out of the private sector? Okay, and that's how we start the money story. And the way a modern state does it, and the way Keynes says it's been done for 10,000 years, is that in the first instance, the state puts a tax liability, extends a tax liability onto the economy. So for this example, let's just say they put a property tax on everybody's house. So now the economy has to pay this tax. At the macro level, there's this tax that has to be paid, but nobody has the thing that's needed to pay the tax. So the state says, look, there's a tax that has to be paid, and it announces its new currency. This is what we need, otherwise, you're going to lose your house. Okay, and so what that does is it creates people willing to sell goods and services to get the funds they need to pay their taxes. So it creates people looking for jobs and employment, looking for the funds they need to pay their taxes. And now, because these people are looking for paid work, and they're looking for the state's currency in return, because that's what you need to pay the tax, the state can now hire them to provision itself. It can hire soldiers, it can hire legal personnel, it can hire public health workers. So that's how the money story starts. So first the state decides it needs to provision itself. Then it levies a tax, say a property tax. This creates people looking for paid work, which, by the way, we call unemployment. Unemployment is people looking for paid work who can't find it. And so the purpose of the tax by design is to create unemployment. So it creates people looking for paid work who can't find it. The state's the only place that has the funds needed to pay the tax. Okay, then the state can hire these people and pay them, and then the tax gets paid. So another MMT observation comes out here, which is, a contribution to the history of thought, and that is, when you look at the actual state spending and taxing, yes, the tax liability comes first. They put a tax on everybody's house, but the next thing that happens is the state spends first and then taxes get paid, because all the funds to pay taxes come from the state, or else they're counterfeit. That's why they have laws against counterfeiting or against any other agent being able to supply the thing that needs to, the state's requiring for tax payments. The funds to pay taxes can come only from the state and its designated agents. Now, in many countries, the states will designate banks as agents and accept bank deposits. But that's, still only works if the state designates them as agents. Okay, so it's always the state and its designated agents that are the single source of the funds to pay taxes. Now, back to your intro about turning litter into money. You take a worthless piece of paper, such as a U.S. dollar, or in the examples, I used to go to in front of a group of people and I take out one of my business cards and say, "Does anybody want to stay after and work? Help me clean up the auditorium here. I'll give you my business cards." And nobody cares. My business cards are just litter at that point. It's not going to motivate anybody to stay after the presentation and work. But when I tell them there's only one door out of this auditorium, and there's a guy there with a 9mm with a gun, and he works for me, and you can't get out of here without one of my business cards, suddenly that card has value. And now, the tax collector, the tax liability combined with the ability to enforce it, the tax collector at the door turns my business card, otherwise worthless business card, into what we call money. And so what we casually call money. And so that business card then has value because of the tax. Okay. And this is not a new concept or anything like that. In a couple hundred years ago, when the British wanted to grow coffee in Africa, the military would move in, they'd have the land for a coffee plantation. There was a population living there, but they had no interest in working in the coffee plantation. They were running their own lives. So there were non-monetary societies. They would hunt and fish and grow crops and pick berries or whatever they did, take care of the children, build houses. And so how did they get them down to the coffee fields? Well, they come up with some worthless piece of script, call it the British Crown, and say, all right, we're going to pay in crown if you come and work in the coffee fields. Of course, nobody cared. The next thing they did was they put a tax on their houses. They called it a hut tax. And they would say, okay, there's 100 crown a month tax on all your houses. And if you don't pay the tax, we've got the military here, we're going to burn down your house. Okay, and so that created unemployment where there wasn't any before. There were no people looking for paid work before. All of a sudden, there are lots of people looking for paid work, and they show up at the coffee field looking for work, and then the British would hire them at whatever, 1 crown a day or something like that, whatever they wanted to pay. And they knew that if the total tax was 10,000 crown a month, they were going to get 10,000 days of labor out of the population for that month, 10,000, whatever that translated into. And so, but it was the same thing. They put a tax on their huts to create unemployment. People would show up for work. They would then pay the people. And then after that, taxes would get paid. So they'd spend first and then later taxes would be paid. So anyway, that's the long answer to your question about turning litter into money. And if the U.S. government today said that Warren Mosler's signed business card was worth $10,000 for tax payments, my cards would be worth $10,000. So making something eligible for taxes gives it that much value. Exactly.
Great. Could you talk about how you replicated that when you launched the currency at University of Missouri, Kansas City, the Buckaroo?
Yes. So I worked with Matt Forstater at the time, and to promote the students' education and monetary education, they were required to do community service anyway. So we changed it into a monetary requirement where the students would have to turn in 20 Buckaroos, which was the name of the currency because the kangaroo was their mascot at the school, and the buck is U.S. dollars are called bucks. So Matt just named them Buckaroos. Each student had to turn in 20 Buckaroos so they couldn't get their grades for the semester. And so now there was a tax liability. This created students willing to work for Buckaroos, unemployment, and then they could earn these by going to the various nonprofits in the area and do community service work, which would pay 1 Buckaroo per hour. And so the students went out and did the work, earned the Buckaroos, and paid their tax. Now, early on, Matt expressed concern that, look, there are going to be some students who aren't going to do community service work. They're going to pay other students US dollars to go do that kind of work. I don't like this or whatever. This is not the intention of the program. I said, well, look, it's a reality of the monetary system. It teaches an important lesson, I think, on how money works and, consequences of a monetary system. And so, let me say, I think it's worthwhile from that point of view. And they decided to go ahead and do the program. And sure enough, there were some students who might have been short a few, and they would pay the other students to go out and earn them for them. But anyway, I did the accounting at the end of the year at the post-Keynesian conference. That was my talk on the Buckaroos. And the total Buckaroo tax, I don't remember what it was, I'll make something up, was maybe 1,000 Buckaroos. And the university wound up spending 1,200 Buckaroos, something like that. So students earned more Buckaroos than they needed to pay the Buckaroo tax. They earned 200 more. Now, why would they do that? Well, they might have wanted to save some for the next semester or the semester after that, maybe just for security. Maybe they gave some to their parents as souvenirs, and for whatever reason. We don't actually need to know. We just know that it happened. And so what happened was the economics department spent 1,200 and only collected 1,000. Now, it wasn't a financial problem because they spent first, like governments do. Okay, they spent 1,200. Out of those, 1,000 were used to pay the tax, and the other 200 remained outstanding in the community, let's call it on the street, then they'd remain outstanding until they were used to pay the Buckaroo tax. Okay, and that is the public debt. It's deficit spending. It's spending more than you collect. And likewise, the public debt in the U.S. is over 20 trillion. Well, that just means the U.S. government has spent 20 trillion more than has been used to pay taxes. And those 20 trillion will remain in the street outstanding, call it the net money supply in the economy, until when and if they're used to pay taxes. But they could remain outstanding forever. And there's nothing else that can be done with them except they can either be used to pay taxes or saved. And today, the street doesn't mean in the street literally. It means in bank accounts, and they can be found in bank accounts mainly at the Federal Reserve and as green pieces of paper that the Federal Reserve issues, which are just bank statements. So they're basically Federal Reserve liabilities. This is the 20-odd trillion the government has spent that hasn't yet been used to pay taxes, and that's all it is. For the economics department, the fact that they had spent more than they collected, did that have any effect on their credit? No, it's got nothing to do with it. Did it crowd out, any activities? No. Did it take away the money somehow from the students? No, it added it. And so, and the students, the government's deficit, the school's deficit, which was 200 Buckaroos, is exactly equal to the 200 Buckaroos that were saved by the students. And it's the same Buckaroos. It's just they're accounted for as the government's deficit and the student savings. And so these lessons were conveyed when I gave this talk. The other interesting thing is, what is the value of a Buckaroo? What is the value of a currency? Well, they all come from the economics department. They all come from the state. It's a case of monopoly. There's no competition. There's nobody else issuing Buckaroos. So it's whatever the state says you have to do to earn it. And they said you've got to do 1 hour of student labor to earn it. So the value of the Buckaroo is naturally, without anybody telling anybody anything, 1 hour of student labor. And when those students who didn't want to go do community service had to pay another student to go do it back in 1997 or 6 or 7 or 8, we did a survey, and they were paying something like $5 for each Buckaroo back then. $5 for Buckaroo. So student labor back then, the market was telling us was worth, a student labor to do community service was worth $5 an hour. A student would take somebody's $5, go do an hour's community service, and give him the Buckaroo and keep the $5 for himself. Okay, when we did the same question last year, it was something like $20. You had to pay a student $20 to get a Buckaroo. So what's happened? Okay, well, the value of the Buckaroo in terms of dollars went up from $5 to $20. Okay, beat the stock market. Okay, but did it actually go up in internally? No, it was internally stable. It bought an hour of the students' labor back, 20 years ago, and it buys 1 hour of student labor today. So it measured the way the school defines it by what you have to do to get it, 1 hour of student labor, the price hasn't, the true value, hasn't changed at all. But in terms of US dollars, it's gone from 5 to 20. So what that tells you is the value of the US dollar has gone down by that amount in terms of student labor. $20 would have bought you 4 hours of student labor back in 1997. Today, $20 buys you 1 hour. Okay, and so the value of the currency is what you have to do to get it from the issuer, from the supplier, from the economics department, or today from the U.S. government. So when the U.S. government says if you serve in the Army for a year, you're getting $40,000, it's defining the value of its currency. It's telling you what you have to do to get it. And collectively, with all its spending, it's telling you what the currency is worth. And so the monopolist is always price setter. You'll learn that your first week in economics, microeconomics 101. And it's a simple case of a monopoly. They've got the money. They tell us what we have to do to get it. That's what it's worth. And there's no way around it. So the way we say it more formally is the price level is necessarily a function of prices paid by government when it spends.
At one point there, you said only the government is allowed to issue the dollar.
Yeah, and its agents.
Yeah, that's kind of where I was going with that. In the past, I've heard you make a distinction between the word money, which is imprecise, and dollars. And right. Could you explain that distinction?
Yeah, well, I only use the word money casually.
Yeah.
Like if we're going out to eat and you ask me, do I have any money or something like that? Yeah. But when we're talking about the economic system and how things work, I find it always better to just use the word I'm talking about. So I'd be talking about dollars that can be used to pay taxes, or commercial bank deposits, or deposits at the Federal Reserve. So you know exactly what I'm talking about, and there's no ambiguity. And so these things get recorded and they're talked about later, and I try and minimize ambiguity. And the word money, more often than not, introduces ambiguity into an answer. So I try to avoid it.
I think you would say, I don't want to put words in your mouth, but would you say there's a difference between pounds issued by the government and pound-denominated credit issued by a commercial bank? See, I'm in the habit of calling the commercial bank credit bank credit, and it's denominated in pounds rather than pounds. And when I'm talking about the government-issued pounds, I say pounds. And that's because of an interview I heard with you a while ago. But, keep me honest, as Steve Grumbine would say.
Okay, so banks pay for things by crediting an account on their own books. So if you sell a pencil to your bank, they'll pay for it. They'll give you a pound in your bank account at that bank. They can't give you a pound to anybody else's bank or the Bank of England, because they don't make entries onto any books except their own. So whenever you buy anything, sell anything to a bank, they pay for it by crediting your account at that bank in pounds. So when you borrow from a bank, what you're actually doing is signing a loan, signing a note, and the bank is buying that loan from you and paying for it by putting putting credit in your account with that many pounds, which in this case is the money, right? Okay, so if you borrow 100,000 pounds from the bank, you sign a note, they buy your signature, your signed note, and they pay for it by crediting your account with 100,000 pounds. So those pounds are a credit balance in that commercial bank. Okay, that's what they are. If the Bank of England buys something, pays the soldiers or whatever, buys a new aircraft carrier, they credit the account of the seller, and the seller usually works through a bank. So maybe the seller's account is at Barclays. So they would credit the account of Barclays at the Bank of England for 100 million pounds or whatever it cost, £1 billion. And so this is a UK Treasury buying something by having the Bank of England credit the account of Barclays Bank, and then that creates a bank account, a bank deposit at the Bank of England. Now, are they both denominated in pounds? Yes. Okay. Are they different things? Yes. One's a bank account at the Bank of England. The other's a bank account at Barclays. Okay. And you have bank accounts at other banks in the UK, and they're different. A bank account if Citibank's a member of the UK system, Bank of England, which I think they are, and you borrow money, pounds from Citibank, and you get a credit there. Now you have a bank account at Citibank. It's different from a bank account at Barclays, which is different from a bank account at the Bank of England. So technically, to answer your question, is there a difference? Yes, there is a difference. Now, that might not be the difference you were referring to or worrying about, but that's all they are. They're just bank accounts at those individual banks. A bank is just a spreadsheet. It's a T account. It's assets on one side of this line and liabilities on the other, and it's an accounting system. It's just an accounting of what happened. You signed a note. They paid you. Here's the account. Accounting is after the fact record keeping. Here's the record of that transaction. They've got £100,000 asset and £100,000 liability. Their liability is your asset. It's all recorded on their bank statement. So that's the fundamental answer to your question. Now you can modify it from there.
Okay. So if I take out a loan to pay my tax bill, what we say, well, in MMT we would say we're returning the government what they already issued when we pay our tax bill.
Okay, so let's just show what happens. So you go to Barclays, you borrow £100,000. You sign a mortgage note on your house. They buy that loan from you, that agreement, and credit your account with £100,000. You now write a check to the Treasury for £100,000. Okay, and on your Barclays bank account. And what the Treasury will do is, when that check clears, they will subtract £100,000 from Barclays' account at the Bank of England, and then Barclays, with a notation on it that those pounds are coming from you, Barclays will then debit your account with them. So you'll wind up with zero in your account, and Barclays will be minus $100,000 in their account at the Bank of England, assuming they started with zero. And when they go minus, that's actually a loan from the Bank of England. So in the first instance, the Bank of England loans Barclays $100,000, to quote, make your tax payment. And that's, now there's the Bank of England has some different steps than the Fed and a few different accounts, but there might be a shortcut in there between an intermediate account being debited and credited. I'm not familiar with, but this is the end result.
And is there much difference between, because that example there, I've put my house on the line for the loan, but one where I go in and they evaluate me on creditworthiness and they give me £1,000 of bank credit because they believe I'm going to pay it back. Yeah,
same thing.
Right.
You sign a note. Okay, now, they are not necessarily allowed to do that because they're a chartered member of the Bank of England, and they're allowed overdraft privileges based on the fact that there's a loan behind it that has value. The state, the UK, determines the collateral requirements for banks because it's their money, right? I use the word money casually here, but it's their pounds that are being created and lent. And so they have a pretty thick book, a pretty long list of rules for what the bank can do and can't do in terms of buying your note. So when I say the value of the currency is based on what the state gets in return, for its spending, okay, the prices it pays when it spends, that includes when it's buying loans, okay, which you could say is the collateral demanded when it lends, which is the same, is logically the same thing as, what it gets when it spends, because it's buying your note. And so if they just said, look, the banks can lend out pounds unsecured on an unlimited basis, you'd have hyperinflation pretty quickly because you just run out and borrow all the money you want, use it to pay taxes and drive up prices. You'd have, infinite demand because you could just borrow pounds again. So borrow all the pounds you can. You just go out and you get infinite demand. So the restrictions they put on lending also are part of the definition of the value of the currency. And so every currency has strict regulations on what kind of lending their member banks can do. Yes, those funds can be used to pay taxes, but there are strict regulations on what you have to do to get those funds, and that's what keeps the whole system in check. Without that, it doesn't work.
So when you talk about money and the origins of money to people in real life and on the internet, when I do, something that comes up a lot is they will say, yeah, but private banks create most of our money. And I like to visualize it like this. I say, you take out a loan, the bank marks up your account. Yes, that's creating money, but you promise to pay them back, creating negative money.
You're conceding too much. You have to start with
okay.
Well, what do you mean by a private bank?
Right.
Okay, so you have a bank that is a member of, like in the U.S., it's a Federal Reserve member. Okay, it's funded by the government through insured deposits. They insure the deposits. They regulate and supervise bank lending, tell them what loans they can make and what loans they can't make. And they tell the banks how much of a capital cushion they have to keep. And they can hire, they have full control over bank management. If they don't like it, they can have the banks replace management. Okay, and they can immediately shut down a bank if they don't like what it's doing. Okay, what a bank can do is price risk. They can set the interest rate. Okay, but that's all they can do. So it's kind of like the military. Everything's controlled by the government, except the soldier can aim his rifle left or right, up or down. So is he private? Sort of, but there's a pretty large public aspect to it. So first of all, when you talk about private banks, you're talking about commercial banks that are members, regulated, supervised, lending. Everything they do is under tight government control. So for all practical purposes, for purposes of the argument that they're making here, they're public entities. Okay, they're not private entities. Yes, they have a for-profit motivation, incentive, but it's based on being able to set interest rates on their loans, and not based on whether they are allowed to make the loan or not. Now they're not forced to make any loan, but they're prohibited from making all kinds of loans. All right, so it's largely a public sector entity. A small aspect is private.
Okay, so I think the reason I tried to get my head around vertical transactions as opposed to horizontal transactions is because you get this next point that comes up where if you explain the difference and say that the money the quote unquote money the commercial bank created, you created a negative version of that money by promising to pay them back. So the two net out to zero.
Yeah, they don't create any. Their assets and liabilities always net to zero. Right. For every loan, there's a deposit. So they don't create net financial assets.
Got it. Yeah. And so, but where I was going with that was, if you emphasize that point with them, that they don't create net financial assets for the private sector, that can be saved, people will then come back with, what about the interest on the loan? Where does that money come from? And there's a phrase of yours that pops into my head, like the government is a net payer of interest, but I don't quite know how to feed it into it.
That's a different point.
Got it.
Yeah, that's a different point. Okay, so when a bank earns interest, that's bank income. So it spends its income. That's where the money to pay interest comes from. It comes from the shareholders of the bank spending their income. Right now, if you get a situation where they don't spend their income, that's called unspent income. And that's always a problem, whether it's, a grocery store where the man everybody buys groceries and he earns a profit and he doesn't spend it. That's no different than the bank earning interest and not spending it. So they're part of the general story about whether income is spent or not. But interest income is no different than any other income. If you get paid to go to work for a company and you don't spend your income, that's the same as a bank putting its money out to work, getting interest and not spending it. It's the same problem. It's exactly the same problem. And that's where unemployment comes from. It's always an unspent income story. And that's why you need deficit spending. For every person who spends less than his income, some other entity has to spend more than its income, or else the output's not sold. All right. So imagine everybody got paid and nobody spent a penny. Nobody spent anything. Well, there'd be no sales, and all the businesses would be broke, and there'd be no output. Right. The whole system goes to zero if nobody spends their income. And it's all a matter of degree. If half the people don't spend their income, the GDP shrinks by half unless somebody spends more than their income to make up for the people who spent less than their income. And the entities that can spend more than their income include anybody in the private sector. They can deficit spend, which is borrowing to spend either from banks or from each other or any other place, or the government, which can spend more than is used to pay taxes. Calling it income is a little bit misleading, but for this purpose, you can call it income. The government is spending more than is being paid in taxes. That's a net payment to the economy. So the deficit spending, either public or private, offsets unspent income. Savings desires are offspent by deficit spending. And without that deficit spending, the savings desires can't get realized. The funds just don't get earned to begin with. If nobody spends any of their money, it's a paradox of thrift, everybody's earnings go to zero because there's no more businesses and no more sales and no more income. It all collapses. So, that's historically been called the paradox of thrift, where desires to save result in less savings unless there's somebody willing to go into debt, spend more than income.
Got it. Great.
So don't confuse bank interest with the general unspent income story. You should always immediately roll that into the general unspent income story. So there's nothing different going on there.
Okay. And the interest income channel topic is kind of why monetary policy has got it backwards all these years. You say that a lot. Yeah, I've
been saying that for 30 years now. So, and this is a question, the other thing we've pointed out is that monetary policy as practiced or as presumed doesn't work. And so they all say if you raise rates, you're tightening policy. And I'm looking at it with states with high debt to GDP ratios, and by high I mean maybe 100% or 80% or whatever. And as the central bank raises rates, the state itself is paying more interest. And they don't raise taxes to make up for that. They just let the deficit go up or the surplus get smaller, depending on this case may be. And so the interest payments go up to the economy, and it's a fiscal transfer. And it's just interest being paid to the economy. I call it basic income for people who already have money. So you just, the U.S. is giving $400 billion a year to people who already have money as a, basic income for those people. And as they raise rates, they're just giving them more. It's like, okay, how is that supposed to slow down the economy? Well, it doesn't. And how is that supposed to prevent inflation? Well, it doesn't. It makes it worse. And so that's been my point of view. Now, there are always other factors involved, but just per se, that's how I look at interest payments. Raising rates is a subsidy to the economy. You lower them, you're taking it away. You go to negative rates, it's just a wealth tax. If you've got a negative 1% rate, you've got 100 pounds in the bank, a year later you have 99. That's the same thing as a 1% tax on your money. It's just a wealth tax. How is that supposed to help the economy? Okay, so look at Europe. They've gone to the Eurozone. What are they, minus 0.4 now? And it hasn't helped the economy. So now they're talking about going more negative. The example I use is a hairdresser who says, no matter how much I cut off, it's still too short. How long is this going to go on? But it's been going on for a long time. It's been 30 years in Japan.
So one common MMT troll you will get is, okay, we understand everything you're saying. Taxes don't fund spending, yada, yada. But something, petrodollar.
Yeah.
And I find it quite frustrating. Could you define what people mean when they talk about the petrodollar?
Well, you can't, because it's usually just unsupported rhetoric, but I think they're talking about the dollars accumulated by oil exporters. And so, Saudi Arabia sells oil to Europe and gets paid in euro. They quote it in dollars, but they get paid in euro, and they have...
Right.
So now they have euro in their account at the European Central Bank. And I guess they call those petro-euros or something, or if they sell oil to the U.S., they get paid in dollars, and so their account at the U.S. bank and Citibank gets credited maybe. So now those are petrodollars because they were earned by selling oil.
Right.
And they talk about, but then they talk about, good thing they recycled those, or else it wouldn't be into the U.S. banks. Well, that's how they get paid. They didn't recycle them back to U.S. banks. There's no such thing. The dollars just get transferred from one bank to another. They don't magically appear when somebody has some oil for sale. And so, anyway, I don't know. If you pin them down to debits and credits and then ask them what their question is, they usually just change the subject.
Right. How about this idea that if a country decides it's leaving the petrodollar, it's not going to use the dollar as a numeraire, I guess? Would that mean, there are now going to be less, there's going to be a lower number in the dollar savings account of the world, and
no.
Does
short
that
answer?
Okay?
You can say whatever you want. The answer is no.
Right then. No, it serves me right to try to ask that question on behalf of somebody else, because I didn't quite get it nailed. All right, moving on.
And again, ask them to trace the debits and credits. What are you talking about? Whose account's credited? Who's debit? Right. They don't have any idea. They wouldn't have made a statement to begin with.
Okay, so here's one from Patricia, who sadly can't be here. During the talk in Scotland in April, you discussed trade and exchange rates. I remember you saying that the exchange rate doesn't matter. What matters is how many goods you give in exchange for goods from abroad. What did you mean by that?
Okay, so that's a little bit out of context.
Okay.
The exchange rate matters enormously for distribution within the country. It doesn't matter for the total wealth of the country. Okay, so like in the case of Scotland, if Scotland, takes 1,000 cases of Scotch whiskey and sends them to Berlin and exchanges them for, let's see, how much money would that be? €1 million, 10 Mercedes, S-Class Mercedes or something, and brings them and has the Mercedes shipped back to Scotland. Okay, those cases of Scotch are going to trade, 1,000 cases of Scotch are going to trade for those 10 Mercedes, no matter whether Scotland's using pounds or the new kilts, or they don't have any currency, or unemployment's high or unemployment's low. It doesn't matter. Okay, the people in Berlin are looking at the Scotch. They're not looking at your currency. What do they care? They're going to say, okay, these are worth so many euro, and so many euro is worth so many Mercedes. It's relative value. Or if they said they're worth so many dollars, and that's worth so many Mercedes, you're going to get the same number. It's just a numeraire, right? So the cases of exports themselves are going to exchange for a certain level of imports, at the macro level. And regardless of whether Scotland has a currency, doesn't have a currency, whether it's just, whether the cases of Scotch were stolen, it doesn't matter, right? So the wealth of Scotland changes. The wealth drops by 1,000 cases of Scotch, which are worthless because you got more than you can drink anyway, presumably. And it goes up by 10 Mercedes. Okay, and those are your real terms of trade. So many cases of Scotch for so many Mercedes. And that doesn't change. Now, what can change if you have a new currency and it goes up or down, is who has to distill the Scotch and who gets to drive the Mercedes. Okay, the distribution of real goods and services will change. Okay, but the real wealth of Scotland doesn't change. So what is the real wealth of Scotland? Well, it's everything you produce domestically adds to your real wealth. That's fixed, regardless of whether your currency goes up or down. That's real wealth. Plus, or minus everything you export, that takes away from your real wealth. You have, you produced all the Scotch, but 1,000 cases is gone. You had to give that up. And in return, you got 100 Mercedes. Now, whether that's balanced trade or not doesn't matter either. If they decided they wanted to save some of your currency and it's not the exact exchange, but you managed to get 10 Mercedes instead of 9 because of whatever, great. Your real terms of trade are 1,000 cases of Scotch for 10 Mercedes. Okay, so that your real wealth now is everything you produce domestically minus the 1,000 your exports minus your scotch you exported plus your imports. So imports make your pile of stuff larger and exports make it smaller. Changes in currency will change the distribution of your domestic production plus your imports. Those are all things you have to distribute to whoever's alive at the time. And that will happen one way or another, during that year. It'll get distributed somehow. And distribution in general is almost 100% a consequence of fiscal policy, taxing, spending through the currency monopoly by the currency monopolist determines to a large extent the majority of your distributional issues. And so, and they get adjusted every year anyway. So you can adjust your distributional issues if you don't like your internal distribution. Things can be done. Taxes can be changed. Spending can be changed. Subsidies can be put in. All kinds of things can be changed and implemented, which are the determinants of distribution anyway. It's not a case of any kind of market or free market because the currency itself is a monopoly. And since you're starting with a monopoly, there is no market. Okay, it's totally state determined. For better or worse, you might not like it. That's fine, and you might want to allow markets to function within that institutional structure, which I completely agree with. They allocate things, but you got to remember they're doing it within this state determined structure, and you have to have that state determined structure. Otherwise, you can't provision the state. You can't have an army. You can't have a legal system, contract law. You can't have public health. You can't have any of that without some kind of coercive taxation that obviates any market. Okay, there is no. It's not market. It's the opposite of a market. Market means competition. So what I'm saying is it makes no sense to operate at less than full employment to try and alleviate some kind of distributional problem. Oh, we've got currency did this, so low-income people are getting hurt, so we're going to put in tight fiscal policy and cause unemployment to help the low-income people. It doesn't make any sense. Keep the full employment policy so you have as much real wealth as possible, and then use your other tools, to reallocate from where they are currently allocating. They're already allocating. Everything's already being allocated by the state. So it's just a question of reallocating.
Yeah, I spoke to John Harvey a few weeks back, and he said the same thing about it's like he talked about Greece in relation to this European Central Bank. The bank calls you up and says you're having trouble repaying your loans. First thing you need to do, quit your job. Have 20% unemployment.
Well, it's even worse. It's like the rumors go around, or the story is that the Greeks are getting punished because they were lazy and they didn't want to work, and that's how they got to where they are. So how do you punish people who are lazy and don't want to work? Oh, put them out of work. So even at the most, basic level, this thing makes no sense.
Yeah. So speaking of monopoly, in the US, you've got a campaign for, not you personally, there is a campaign for Medicare for all. In the UK, we've got the NHS, which has been under ideological attack for a long time. The attack was stepped up in recent years under austerity, and austerity says we've run out of money, we need to cut. MMT says there's no such thing as the government running out of money, write the check. But also, isn't there a deeper argument for having a purely public-owned national health service to do with economies of scale and natural monopoly? Nobody's got a bigger checkbook than the government. What are your thoughts on that?
Oh, yeah, well, several points of view. Most importantly, if you've decided as a nation you're not going to just let people die in the streets, you've got single payer state, funded healthcare. And if you start mixing that with everything else and just pick up people in the street who are dying, that's like the least efficient way to do it. Because then you're getting people who have, insurance companies will start cherry picking only the best ones, and the others will be left in the street to die for the state to pick up. And it's totally inefficient, So once you decided you're not going to let people die in the streets, the state will take people off the streets to care for them. Then you've got single payer, whether you like it or not. And then it's a question of making it efficient. And when you have multiple companies competing with each other, keep costs down, that's worth something, but they also have sales and marketing costs and everything else. And like you said, economies of scale and all kinds of other incentives that get thrown in through legislative institutional structure that somehow they can't help themselves, maybe because of lobbyists or whatever. So you get all kinds of masses of things, and it's been estimated in the U.S. that the administrative costs, if you look at them, are maybe 7 or 8% for Medicare, or maybe 24 or 25% for the private insurance companies, and so you save all those administrative costs. Okay, so
which is why you say moving to Medicare for all is a deflationary event.
Yeah, because that savings means people who, that money was $1 trillion or whatever it is people who are getting paid, which could be 5 million or more people are going to be out of work, and rightly so. They're doing something that is like digging holes and filling it in, advertising for insurance companies. When you have a single payer, you just don't need it anymore. It's redundant. And these are good people. So what you want to do is have a strong enough economy where they immediately get redeployed into some other business, some other private sector, endeavor. Yeah.
For which they're going to need a transition job, but we'll come on to that later.
Well, but before that, what you do is when we go to Medicare for All here, or as it's been said, Medicare FRAL, F-R-A-L-L. Medicare fraud.
Warren, could I just interrupt you and say, could you define single payer for Brits? Because we're just used to NHS and not NHS.
Yeah, well, that's the single payer is the government rather than having multiple insurance payers. By payer, we mean people who, insurance companies. They're called the payer.
Got it. Thank you.
Yeah. So with the NHS, you've got single payer, just the NHS pays for everything. And, it should be adequately funded. And the problem is whether or not it's adequately funded. Now, there is a point where you cannot afford to do it, to adequately fund it. If you determine adequately funded as every person gets, 10 private duty nurses at his side for everything. You walk in for a Band-Aid and you got 10 private duty nurses, okay? There aren't enough people in the UK to do that. You can't, you're limited, your real resources are limited. So you want to make it efficient, but you want to make it competent. So you get to the level of competency that you want, you determine what that is, then determine how many people that's going to take, how many doctors that's going to take, determine whether or not you have that kind of capacity available, and that will tell you your affordability. It'll also tell you where you need investment. So if you've got lots of people but not a lot of doctors, well, then you need some kind of investment in doctors, or you need to open it up to importing doctors or something like that. So if you want your people to be doing something else. So you've got a big matrix to figure out in terms of real resources when you're a government. If you take everybody off the street and put them in the government, then there's nobody to grow the food and nobody to do anything else. You're all going to starve. You can't have everybody in government, I guess, unless government's going to grow the food. But there's a lot of activity that's much better left to the private sector than government, and you determine what that is and make sure, and then you have a trade-off, because the more government you have, the less private sector you have. And so you have to determine what's the right size, and then the monetary system can accomplish it. But, you can't have, 3 halves, right? There's only 2 halves to a whole. That was Reaganomics, where, half the budget would go to the debt, to the social spending, half would go to the military, and the other half would go to interest on the debt, whatever. But you can't have 3 halves. And so...
to that, I think even a part privatized health system where if you can afford to pay, you pay for the same service that somebody who can't pay gets for free. For instance, I have to pay a prescription charge. Right, most people do unless they've got an exemption just to pick up a prescription. It's in the order of £10. But to me, it's like that doesn't pay for the drugs. That seems like a tax.
Yeah, well, we call that means testing.
Right.
And where people who have more money don't have the same access, and I don't. To me, I'm not there yet. We don't have that with Medicare. It works perfectly well. Everybody likes it. We do have supplemental policies that people buy. I would include those in the regular Medicare, the supplemental policies. And if somebody wants, a policy where he can go off and get a private room in a hotel in New York or something, fine. But even then, I think I'm sort of in favor of limitations on that, because it tends to take away real resources from everybody else. It's kind of like it's regressive in that sense, but it's not a problem. So I wouldn't start with that initially, but I just kind of have an eye on that type of thing where, because then there's incentives to defund the national health system when people can buy out of it. And the people who have the money to buy out of it oftentimes have the influence to defund everybody else, to keep their taxes down, so to speak. And so I'm very leery of, having people be able to privately buy better health care than everybody else gets, because it's a huge incentive to have them work against what everybody else is getting.
That was the MMT Podcast with Patricia Pino and Christian Riley. You can become a supporter of our work by going to patreon.com/MMT Podcast. Get in touch with us on Twitter at MMT Podcast, or I'm at Christ Riley, spelled ChristReilly. And Patricia is at Patricia N. Pino, spelled PATRICIANPINO. You can also email me at christriley@outlook.com. Thanks for listening, and we hope to hear from you.
You can edit all this out later.
Oh, yeah, absolutely, yeah. In fact, you can do the dishes while you're doing it if you want.
Yeah.